I want to talk a little bit more about what investors should know today, and joining us for that is Sandi Bragar, who is partner at Aspiriant. Sandi, how are you feeling about things? We had seen markets tick up pretty significantly in the beginning parts of this month. This morning, not so much.
Becky, we have been pleased with the rally that we've had over the last 3 months or so. Equities in our portfolios are up 15%. So this week we've been very busy rebalancing portfolio, selling off stocks that are above targets, buying other things in the portfolio like bonds and liquid alternatives to keep everything afloat. We are concerned that the market has been too focused on inflation. We think recession is a definite risk. And in this market, we're not making any high conviction bets on what the Fed's doing, what's going to happen with inflation, nor any big bets around recession. Instead, we think the better, more prudent way to move forward is to maintain diversified portfolios. And that's what we're doing for our clients who are corporate executives, family business owners, and entrepreneurs.
Did I hear that right? Markets went up, equities markets went up, so you sold lots of stock and diversified into things like bonds and other places. Are there any stocks that you've bought?
Yeah, in our portfolios within the U.S. portion of the portfolios, we're highly tilted toward value stocks and toward quality stocks. And quality stocks for us are companies with really strong balance sheets. They do well in good economic times and poor economic times. They have little or no debt on their books, and they tend to have less volatility. So TJX Companies is an example of one of those stocks. And it meets the value criteria, too, as being underpriced. That's a stock we like a lot. They own the TJ Maxx, Marshalls, and home goods stores throughout the United States, Canada, Europe, and Australia. And in times when it does look like the country is facing recession, their brands of more affordable priced goods and apparel are definitely in more demand.
So what have you been selling the last week or two?
We've been selling some of the growth stocks in the portfolio that have been falling off. And again, stocks generally, with the tilt toward value and quality, those stocks have done really well in the last 3 months. So we've been broadly selling those off. So companies like Microsoft and Apple.
You sold Microsoft before the earnings?
In some of our portfolios, we did. And in other portfolios, Becky, we've been actually shaving off some of the equity allocations and moving into bonds as a more permanent proposition, because bonds are starting to retain their more normal role in the portfolio, delivering strong returns, dampening portfolio volatility, and hedging against equity risks, which we see mounting and which the markets are pointing toward today.
What kind of allocation have you had maybe the last 5 or 8 years in terms of stocks versus bonds, and what are you kind of moving towards now?
Yeah, I think the more interesting spot is the last few years. So in 2020, as we were expecting the Fed to begin interest rate increases, we backed off from bonds at about 40% of the portfolio down to about 20%, and moved that differential into stocks. And now we're starting to march backwards toward bonds with a 5% move in some of our portfolios this week.
All right, that sounds pretty prescient. Sandi, thank you for your time today.
Thank you. It's been a pleasure.